Or good morning, good evening, depending where in the world you are. Welcome to our next in a series of Global Process Owner webcasts, specifically today looking at the record-to-report cycle. Today's session is entitled Financial Close, Accelerating, Assuring, and Integrating the End-to-End Process. So thank you very much for joining us. We've got people here from Europe, North America, and other parts of the world, so welcome. This is a 45-minute session, so hopefully you have that in your calendars. Before we get into the meat of the session, just want to tell you a little bit about the mechanics. You will see on your interface to the webcast there's an opportunity to ask questions, so please ask questions as we go through. As they dawn on you, enter the questions in, and we'll endeavor to answer them at the end. If we don't get the opportunity to do them today, we'll respond to you by email. If you have any technical issues using the webcast service itself, then please fill in one of those questions and someone will get back to you and help you out. So that's the housekeeping dealt with. So I'd like to introduce you to today's speakers. My name is Dan French. I'm founder and CEO of Consider Solutions. Many of you know me. I'm very pleased to have with me today Josh May, who's Group Financial Reporting Manager at Camelot Group. So welcome, Josh.
Hi, good afternoon. Thank you.
I can assure you we both look a lot more charming in real life than we do in our photographs, but you will have to trust me on that one. So a few words about Consider. Many of you know us or work with us already, but for those of you who don't, we're helping organizations around the world to achieve this, getting this journey to this state of nirvana known as world-class finance, which really is indicated by the little schematic on the bottom right there, helping the organization drive the optimal business results, reducing the cost of finance, and I just saw recently a new piece of research that says the average cost of finance amongst large organizations has now dropped to 1.2% of revenue. The best in the world are at 0.7%, and the goal, I think, still remains for 0.5% of revenue as a cost of finance. So that's a key goal. Optimizing cash flow, and of course managing risk. And you'll see our key areas of footprint there: financial control and compliance, which is part of today's discussion, broader risk assurance, and process optimization, which is also part of today's discussion. And you see there the kind of solution areas we're operating in. We work with clients around the world. You'll recognize some of these logos, and some of you are actually on this webcast, so you know who you are. But without any further ado, let's look at the agenda for today. I'm going to start with a few thoughts on the challenges in the financial close process and a little bit of insight into financial close automation, the art of the possible. And then Josh is going to give us some insights in the Camelot Group experience. And then we're going to round out with some conclusions and lessons learned and come back to your questions. And we'll be concluding in 45 minutes. So let's take a look at world-class finance and where we are in that world. Most organizations have really built a foundation of centralization, common systems, standardization, and simplification as far as possible. And we're seeing significant results. Financial savings, we talked about the latest research. That's definitely good news. Certainly with the best in class getting 0.7% is certainly moving on. Getting predictable results. With the past few years of focus on compliance, we've got a compliance-ready organization, and organizations with a mission. Whether or not you're in shared services or conventional finance, we've certainly made a big step forward. When we look at opportunities to improve, however, the three big cycles, obviously the revenue cycle, the order to cash, the cash disbursements, the purchase to pay and accounts payable piece, and general accounting and reporting, record to report. You can see the difference there. This is Hackett Group's data points. Difference between the world class and the rest, or the best and the rest, is interesting, but it's very obvious the biggest opportunity still remains in the record-to-report cycle. So it's almost the best are operating at nearly twice as efficiently as the rest. So there's some work to be done there. And it may be that the reason that cash disbursements is the closest is just because that's the obvious place to start. But today we're focused on record-to-report, and most people are focusing on how do we drive that, drive efficiency there in standardizing, simplifying, rationalizing coding structures and chart of accounts, clarifying policies and procedures, strengthening governance, making sure the team understand the end-to-end process, not just their own individual component. And the big shift now is the appointment of global process owners for record to report and the other major cycles, and also the implementation of financial close automation solutions that help drive some of this. So there's some interesting data points there. When we look at the whole end-to-end record-to-report cycle, if you're a global process owner, this will be familiar to you. We're really talking about those from the close-to-report cycle today, the close-to-report piece, which some people regard as the last mile of finance. So that's what we're looking at, and you see the obvious components there. And underpinning that, you see these key areas of process procedures, policies, coding structures, etc., process placement, controls, and compliance. And our discussion today is going to be very much about process and procedures, controls and compliance, and automation and tools, although we'll touch a little bit on skills and organization. So that's the context, if you like, for what we're discussing today. And just in terms of a specific benchmark, it might be relevant. This benchmark comes from APQC, and just interesting to see the total cost to perform general accounting per $1,000 of revenue, and you can see some massive shifts. In fact, it's kind of the best operating at 5 times more efficient than the worst. So that's worth thinking about. Interestingly enough, the difference to shared services and self-supporting traditional is nowhere near as significant as the difference between the best and the rest. So that's sometimes worth doing a basic measure on. So when we think about the close-to-report cycle, it is frightening, I think, fair to say, that the typical close process is still stuck in yesteryear. It is 2015, I believe, and the typical process has got, I mean, a thing on the bottom right there, the document-centric annotation, signing off documents, physical journals is still very much a thing of the present for many people. Filing cabinets full of documentation. We've got a whole bunch of stakeholders, and we've got our ERP systems driving information to us, and reconciliations and the like to be done. But we've still got a very labor-intensive, document-heavy process, which is highly error-prone. So, it's pretty clear how we need to simplify that. I think the question for many is what do we actually do? So some of the common issues and choke points. Our character out of Mad Men there is concerned about these things, but you all go through this, whether it's the transaction matching, whether it's complying with policies and standards, certifying completeness and accuracy, making sure you're ready for the auditors, which is painful at best. What do we do when the numbers change? We have new accruals coming in. What about manual account reconciliations? How do we ensure that's right? So these are all the things that are concerning the team in the close cycle. So how do we take some of that pain away? So talk a little bit about financial close automation in principle, and then we'll hear from Josh about his experiences. So in principle, financial close automation tools are designed to do what ERPs don't do well, essentially. The ERPs are very good at transaction processing, but this, as we know, this whole issue of the financial closing process is very document-centric. There's a lot of need to deal with checking of data, matching, and reconciling data, which has got to be authorized and approved. And most people are still doing that in Excel today. So across the various stakeholders, we've got account reconciliation, we've got matching, we've got journal entries to make sure are approved, we've got variance analysis, and so on. I'll just talk briefly through those. So critical capabilities of financial close automation basically needs to have workflow management, task assignment, document control, and the ability to manage that cycle, manage documents, manage certification, manage the audit trail. And so we don't have to resort to Excel spreadsheets and large documents, and providing visibility and metrics around that. Account reconciliations being the key capability there, just basically ensuring that we can automatically import GL balances and journals, and we can have a standard set of reconciliation templates with rules, and have automated calculations and checks, and build in all the supporting documentation and comments. High volume matching, to be able to take large quantities of data that needs matching from any source, to be able to do at a high speed, whether it's one-to-one matching, one-to-many, or many-to-many matching, using algorithms we can build into tools. Journal entry management, very important, the ability to be able to validate and have rules-based validation, lookup tables, standard templates, import of data from multiple sources, and automatic posting. Variance analysis is critical because as the numbers change, it's very important we understand the numbers. If we don't understand the numbers, we don't understand the story behind them, and we need to have a narrative to support management in explaining the numbers at the close. So this is critical to understand for explanation of variances and keeping track of variances. And then finally, basically the integrity between consolidation and general ledgers, making sure that we can manage that integrity, make sure we have a clear, defined, synchronized relationship between the two, identifying out-of-balance accounts and differences, be able to manage those, explain them, linking to underlying reconciliations, and then if there's any discrepancy, get some automated support for that. So that's a kind of quick sort of helicopter view of what the art of the possible is, what these financial close automation capabilities need to provide us. But let's talk to Josh and see what some real experiences have been in the world of Camelot. So welcome, Josh.
Hello, thank you.
Camelot, as you know, is, or many of you will know, is the lottery organizer and one of the most efficient lottery gaming organizers in Europe, and we'll hear a little bit about that. So tell us a little bit, Josh, about Camelot. Tell us some facts about the business.
Sure. It started in 1994. The then Prime Minister, John Major, had seen the benefits derived from running national lotteries in other countries successfully around the world and decided this would be a good thing for the UK to raise large amounts of money for good causes throughout the country. The initial goal was to raise £1 billion over the first license, and recently we passed, since that time, so it's been now 21 years, and since that time we've just passed the £33 billion mark, which is a fantastic achievement. As a rule, we aim to, the company's ethos is to maximize the returns to good causes. We do successfully raise a very large amount of money for the good causes throughout the UK and certain specified good causes around the world. It's a business with a turnover in the region of £7 billion with 800 plus staff based out in Watford in North London. We do manage and offer lottery-related services to other countries and other states around the world, in the US, in parts of Asia. We're looking at a number of them. Any that are coming up at the moment, we're keen to at least review. We've got a good track record of running the UK lottery as well as the Euro Millions lottery, and I think it's a very high-profile brand. The Lotto, the scratch cards, the Euro Millions provides us with the main bulk of our revenue throughout a year. We are specified as part of the license to have a certain level of returns of good causes as well as prizes, and we have strict regulations in terms of headcount, minimum spend, etc., etc. So we have our hands tied to a certain extent, but as I say, the company ethos is all geared to returning the maximum amount of money to good causes.
That's a phenomenal result there, raising over 33 billion.
Yeah.
That's, I mean, we all know about the individual prize winners that we read about in the papers on TV, but to see that, it's stunning. So, and the other piece I think is very, not well known is the fact you run your business on about 4% of the revenue on total operating costs is amazing. There's no other business I can imagine that operates that way. So that's,
absolutely. I mean, it is unique in the UK. We know we're in a privileged position to be running the Lotto. We're really only guardians for it. We're running the third license successfully at the moment, and we appreciate that we're the guardians of what's become a kind of national treasure. It is a great industry to work in, and a very fun firm to work in, as well as quite an empowering one. We regularly have team meetings where we sit down and get some feedback as to where the money's going. We don't actually decide where the money goes, but we do see the benefit of where it goes. When you see some of the people who have benefited from it, it's quite motivating. It really is.
So with this kind of very unique structure of business, what context does that set for transformation initiatives in finance?
Oh, well, we are always under pressure to improve our efficiency, to ensure that we have a very cost-effective way of working. We are constantly being challenged to improve efficiency, particularly in my area in the finance department, we're always looking for ways to automate, to produce a more efficient reporting process, to increase the transparency of the figures we're reporting so that the management can make better decisions, and to generally see to maximise the amount of A returns on good causes. Obviously, we are a profit-making company, so we have to keep an eye on the amount we're returning to our parent company, who are the Ontario Teachers Pension Plan out of Canada. But as I say, the ethos is all based around returning the money.
Well, okay. So when you looked at the close cycle, what was the big issue you were looking to address?
I think, as with every finance department, you want to minimise the length of time that it takes to report the figures to the senior management. And although the reporting process was relatively efficient to begin with, it did seem that we were very heavily reliant on Excel spreadsheets, which I think you touched on earlier. I think many firms are guilty of it, and really it was to get us off Excel and into a more automated solution with a hands-off approach so that we could report a lot sooner, and where possible make amendments in the same period rather than having it sitting in the balance sheet until a following period where things do get lost sitting in the balance sheet, and ultimately one day you have to send that to the P&L, it's going to end up in the wrong period, and it's just embarrassing. So try and get it resolved within the period. So if you can close the figures even at a flash stage, report sooner, identify amendments required, then you can address those in a timely fashion.
I mean, Excel is an amazing personal productivity tool, but I don't think even Bill Gates imagined that people would be running entire business processes.
No, that's right. And there was the example of, I won't name names, but there was a very high-profile case of an American investment bank that recently had a £4 billion hole in its balance sheet as a result of a formula error in an Excel spreadsheet. And it's that sort of risk which we're looking to avoid, as well as increasing efficiency and simply allowing us to spend more time reviewing the figures rather than preparing them.
Right. Yep. So you talked about, obviously, the cycle time's a key thing for flash figures and firm figures, but the broader kind of efficiency, quality, risk play, were they important to you, or is it purely cycle time you're focused on?
I mean, obviously, it's a kind of balance of the two, really. We want to get the figures prepared as soon as possible. We do as much as we can in advance of the period end, but ultimately you do have to wait until you've finished trading for the period. Certainly, I mean, in our case, we were fairly unique in that our period closes on at the end of the largest revenue-generating event of the period, which is the lotto draw on a Saturday night. So our period end is on a Saturday, which is relatively unique. So for the end of February, for instance, it was the 21st of February, which seems a rather odd day to be saying, oh, it's month end again. But yes, it's we look to close as early as we can do, so that I can then take away the figures, churn them out in a state that I feel is appropriate. We can knuckle down and start reviewing the figures, highlighting where we think there are areas that we need to investigate further, whether that's corrections or reporting in a different format.
Right. Okay, so what does financial close automation actually give you as a finance department?
Well, we've recently brought in a financial reporting solution which has allowed us to take off a day or two a month from our reporting cycle. This has produced some amazing results in terms of we're now closing down the month end a lot earlier than we were beforehand, allowing us to focus on areas such as balance sheet reconciliations. And in doing so, when we're preparing the recs, we're able to see where items maybe should have been taken to the P&L, or we should have increased or reduced accruals as appropriate. And this allows us often to make the amendments required before we've actually officially closed. Right. Therefore, we're in a position where when we report to senior management, we can say with some level of authority that we're happy with how the accounts are looking. Right. It's really given us a lot more efficiency in the department. In terms of reporting on the balance sheet, I've always kind of taken the view that if your balance sheet is nice and clean, you have a lot more reassurance that your P&L is nice and clean. Yeah. And this does mean that whereas before we were spending a good kind of 6 or 7 days preparing the high-risk balance sheet recs, we're now doing it in 5 or under. and as a result we can ensure they're nice and clean and they're all signed off. And it does mean that the month-end process doesn't drag on all month. I've worked in firms where you finish one month-end and you're starting on the next one, and it means as accountants we're not just slaves to balance sheet recs, to month-end reporting, etc. It allows us to actually get on and do other things, which keeps us happy.
Good. So you've got a 5 working day close, and what do you you mentioned earlier about the number of working days for the flash figures. What's that for you?
Yes, we're preparing the first set of flash figures on or around Workday 5. It allows us to run some of the figures out around certain people around the firm before we've officially closed, and gives them the chance to feedback and to make suggestions, make amendments as required. I mean, and so if there was a major omission or something we wanted to include, something that they go, oh, I haven't told you I need to accrue for,
yes,
is a kind of a stock standard phrase that one hears quite often in finance, then we can include that before we have made the final official close and run up the figures to senior management.
Right. Okay. So how did we go about selecting and implementing your solution?
We did investigate quite thoroughly the marketplace for the solutions out there, and we had criteria as to what we wanted to achieve. The first one being which would offer the most automation, had to be user-friendly, it had to tie in with our ERP. We use SAP, so it had to be SAP-friendly. It had to be one that we could implement ourselves. We wouldn't be reliant on external contractors coming in and A, costing a lot, B, taking a lot of time, and C, when they've done the work, anything breaks, where you're somewhat reliant on them to come and fix it. So we wanted one that was user-friendly with a good support network that we could turn to in times of trouble.
Right. And how much preparation or changes to ways of working did it require? Was there a big culture shift or a big education requirement?
Not really. I mean, the one we've actually gone with was very self-explanatory. There were very good procedure notes in place. There was a WebEx support system, so a phone call or an email, and I could set up a WebEx and actually have somebody looking at my screen and they can talk me through it. There were very good online tutorials, some excellent procedure notes in place, and a support line to help as and when required. We wanted to, we didn't really want to be going through a process of upheaval to get this process installed. We wanted it to fit in around us, to support us, not us to have to change everything we did to fit this new piece of software. Right. It was always going to be a hard sell with certain people who are, in the nicest possible way, slightly happy with the way things work at the moment. I think it's a very diplomatic way of putting it.
Very diplomatic.
Yeah.
But it was not so that was good. So you didn't have to go and design a whole new process. You could use the current process with the technology.
Yes,
absolutely. It's a story you hear very often these days.
No, quite.
Well, that's fascinating. So let's talk a little bit about the give and the get. What did you and the organisation have to give over what period to get the solution implemented, and what did you feel you got back in return for that? What's different about your period end close now to the way it was before?
Sure.
And give us some texture on that.
We had I'd say about a 3-month investigation process where we met with a number of suppliers and decided on the one we liked. Whittled that down quite quickly to 3 suppliers, sorry. And the one we liked most, it was fairly apparent from very early on which one we liked best. They came in, they spoke to us, were very charming, gave us a fantastic demonstration, looked at our SAP system and said, that this would be very easy to install. From the moment we signed up, we had about a 6-month lead time. It could have been done considerably quicker if we'd assigned a team of people to it and wholeheartedly donated more time to it. If I'm honest, hand on heart, we could have done it an awful lot quicker. But as it was, we still managed to do it in 6 months, which I still maintain is really not too bad.
You did it in 6 months with essentially the team of people you were using that were already working there?
Yes, absolutely. With the finance team we had there, I personally was the one who single-handedly went through the installation process with a lot of support from the software provider remotely. They're based in the States, so it it was then working some slightly strange hours to fit in with my I say 9 to 5. It's not quite a 9 to 5, but the working business UK working hours, and they were absolutely excellent. Supported us throughout. I provided a chart of accounts, did some journaling, etc., etc. Did some training myself, and then was able to pass on the training, which is a very good way of ensuring you really are you're on top of your game in terms of understanding how the system works. So I'm the admin, the administrator for the software. So I do feel that if something goes wrong, I've got a fairly good chance of being able to resolve it myself. But it's nice to know that there's somebody at the end of the phone who can help me ultimately.
So if you had enough time to do all this as well, you obviously didn't have enough to do before.
Well, yeah, I hope my boss isn't listening. It was you
saw the moon many evenings.
Yeah, that's right. Yes, that's right. It was a hard. It was a long experience over 6 months. There was a lot of hard work getting it in, but it was quite a rewarding process, and certainly the first couple of months then when we saw it all working, and it became immediately apparent that this was a good thing and this was really going to start saving some serious time. The rewards were immediate and really apparent. It's been really satisfying to see the fruits of your labour for once. You so often produce reports and don't even get any feedback. To actually hear back from people in my team who gave me some positive feedback, and to see ultimately to see the period end close being pegged back some, which is ultimately what we want. We wanted to peg it back so that we could start reviewing the figures earlier, and we've been able to. So proof in the pudding is that yes, we've now got a slightly more efficient period end process.
Right. So what's different for the business and like your internal customers, if you like? What's different for them?
Well, if in terms of the internal customers within the finance team, we are now able to produce the numbers earlier. We're able to spend more time reviewing the figures so that they, in essence, are receiving a good quality set of numbers when they're coming in. We're able to review what's sitting in the balance sheet and get back to them and start asking questions along the lines of, should this still be sitting here, etc., etc. We know that the numbers we're reporting aren't going to have any shocks at the period end. From the auditor perspective, they're incredibly happy to see a very high standard of reconciliation being produced on a monthly basis. They're able to remotely access them, so they don't have to make the journey into the office quite as often as they do. Our external auditors, yeah, we've given them a read-only access. Right. So they're able to have a look at it. They don't have to carry lever arch folders galore across London with all the inherent risks within that. The backup is attached and is saved out there in the cloud somewhere. And ultimately, the internal audit function are happy as well because they know that we've got very good control around it. We don't have to worry about locking cupboards with a couple of hundred folders in it. It's all saved online and password protected.
So it sounds like you're really on the front foot now. Quite often in closing, the team's on the back foot, being under pressure. So you're able to add more value, give more advice and counsel to management.
No, definitely, and it did spur us on to do a kind of chart of accounts review. So we identified that there were 3,500 balance sheets in our balance sheet accounts rather in our chart of accounts in SAP, and it's using this software. We did a review, and we've identified that there are a number of them which we're simply not using as often as we need to, and we've on the back of that started on a journey to go through and close down some, merge others, open others up to make it a little bit more reflective of the actual way the company is working.
Right. So you mentioned your external auditors. So your audit process is slightly more seamless and painless, or is it the same as it was?
It is
in your office.
Well, that's right. Yeah, we love our auditors in case again they're listening. But yeah, it's a very good package we've gone for because it allows them to review them, and if they have any questions, which last year I had to say they didn't have any questions at all, whereas the previous year we would have audit juniors coming around often asking the same questions about the same recs. With remote access, we just found that questions just dropped off a cliff. There were hardly any. It was mentioned in the audit close meeting that they were very pleased with this new software and the standard of the reconciliations. It was noted in the minutes that the quality of the recs had improved, because now, of course, we have a stock standard set of a dozen types of reconciliations, and we fit them into the different areas of the accounts, and everybody who produces those recs has to fit it in with one of those templates, and it saves time actually setting the rec up. The backup is always attached. You can prove that somebody has reconciled it to. We're allowed to. Whereas back in the day we always reconciled it to the penny. We now take a more pragmatic approach there. If we're reconciling it every single rec on a periodic review, if we're doing that, we allow people to reconcile to within X% of the total balance. So we might say to within 0.5% of the balance. It allows us that freedom, especially on the lower risk recs where we're almost generous, I'd say.
But don't get too generous.
Not too generous. No, absolutely.
So what impact has it had on the team, the finance staff themselves? How has it changed their lives?
It frees up much more time. So at the period end, they're able to focus on other areas. It does cut back on some of the late nights involved in reconciliations. We're producing them, as I keep whittering on about how early they're produced. We do reconcile them far more thoroughly and regularly than we used to. In fact, we used to try and reconcile all of the recs on a monthly basis, certainly quarterly for all the recs, whereas now we've had a review, we've gone through and we said, right, all the high-risk reconciliations, we'll do this every month, irrespective. All the ones that don't move, or ones with a low balance, certain carried forward accounts, the fixed asset register, etc., we won't reconcile them every month. There is just no point. If they're not going to move, we'll only reconcile them every quarter, and the software tells us, based on a few parameters, which ones to reconcile them on.
Right.
And it cuts down a lot of time. So as a manager, it's saved me a lot of time. As a preparer, it's saved a lot of time, and it saves time and effort from the audit function, both internal and external, because they know which ones to look at, because they can run software that shows them these are the high-risk ones, focus on these.
Right. So the team isn't just hammering away on the balance sheet, they're doing something useful.
Yeah, absolutely. They're not preparing, 10 pence recs or whatever, which is, let's face it, unless there's been £1 million move in one direction, £1 million and 10 pence in the other, there's no point in preparing a 10 pence rec.
Right. That's very interesting. And obviously it's had a profound effect on you.
Yeah, that's right. I'm a new man.
So where are you on your overall finance transformation journey? I mean, clearly this automating the close and reconciliations processes have been a big deal for you. Where does this take you on the big path?
Well, we started out on this journey a couple of years ago with the goal of providing automated solutions to enable us to be a bit more efficient in our ways of working. We're as part of the Camelot operating license, we are capped in the headcount we're allowed. And on the back of that, we do have to ensure that we work smartly to make up for lack of headcount in certain areas. So we're almost, as a result of that, we're encouraged to look for automated solutions which do cut down on the amount of time we have to spend on certain areas. But also it cuts down on risk and errors we're finding. So there are so many positives on that. We're still very early on in the process. The software supplier we have doesn't just do reconciliations. It has a number of features. There are modules galore in there. It has monthly task management. There are journal upload features. There's matching involved, variance analysis. They're constantly working on bringing out new modules, and in fact, as one of the longest standings, it's quite a new company. Us being customers for 2 years now makes us one of the longest standing customers there, and they've listened to what we said, and we've asked for certain things to be brought on board, such as financial statements, generating software, etc. And they've listened to us, and they're working away on that. And there's an online community which we can go on and register, and our user herd, we share ideas, we have user group meetings, etc., to share ideas about the reporting process.
That's an interesting point. So how valuable do you find that to both the online community and the physical user community? Does that add value to you as a...
Oh, it does. It does. It's something that that they have their annual meetup where everybody gets together, and they have speakers, and it's nice to see people face to face. But the actual online, if you want an instant answer, go out there, you throw the question out there, and invariably there's somebody who's experienced that. And it's a nice way of asking a generic question without giving any company secrets away, and often getting an answer to something that nobody in the office can help. I like bouncing ideas off my colleagues and meeting people face to face. But ultimately, if that doesn't resolve the issue, I can just chuck a question out there and see what happens.
Excellent. So, looking back, what would you do differently over this period you've been doing this?
Yeah, tough question. I think probably the obvious answer would be I wish I'd started this sooner in terms of the benefits we've seen. We could have had those benefits considerably earlier if we decided to have gone down this automation route and chosen the software to help us earlier on.
Right.
I don't know why anybody would want to carry on struggling with a long drawn-out period-end process when there are solutions out there, and they are absolutely excellent solutions. They really do. And every day there's another leap forward in this. So just my recommendation would be get out there and see what's out there that can help.
So start earlier, but also how would you you had a 6-month implementation. You mentioned you could have done that quicker.
Yeah.
Would you have done something differently there to accelerate that?
Yes, I think in hindsight I'd like to have focused my entire time on that. As with I'm sure many people listening this afternoon will sympathise. You can't necessarily down tools and just focus on one task. Life is a juggling act we have in finance, and I had a number of things I had to do. Again, you're right. In hindsight, if I had just down tools and got on with this, we could have reaped the benefits of this maybe a few months earlier, maybe 3 months earlier. Who knows? And certainly, if I'd have had a small team working on it and we'd focused on this, who knows how quickly we could have got this in. It really is a very user-friendly implementation process.
Well, it's very, it's pretty exciting. You managed to do that yourselves, and there was no kind of army of external consultancy.
Yeah, absolutely. And I'm no expert. I mean, really, I'm just an accountant.
So, are there any just an accountant?
Oh no, sorry. I know. How rude.
So, are there any other lessons you'd like to share from your experience?
Certainly, I mean, get buy-in from all the stakeholders involved in the process. It's something that if you do the research yourself and you take it to somebody senior and let them trumpet your case, certainly I found that this was an edict from on high that they wanted further automation, and they said to me, that this is something we'd like you to install. So I was very happy to do that, and if I'd realised the benefits beforehand, I would have got more people involved, I think. There was a minimal input from our IT function from the Camelot perspective, much more on the actual software provider side, but certainly get a good group of stakeholders involved from the IT function, from finance, from other areas, get the auditors involved nice and early, get sign-off from them, don't wait till the actual audit comes around, get them involved. They will have heard of the software you're going to use, so get them on board. Invariably they'll have some advice they can give you, and ask the software provider, what can you advise? Ask for immediate access to the online community, because they too will offer some invaluable advice on what to do while installing the software.
That's very good guidance. Thanks. Any other advice for anybody looking at financial close automation?
Certainly there are many options out there. You may think, oh, Excel's fine for me. I don't need Excel. Really, Excel is excellent. I can't say I don't use Excel. I don't know many firms who don't use Excel at all. But there are just so many better options out there where an automated solution just runs things quicker, more accurately. It highlights areas that you need to be focusing on, and generally just do all you can to get off Excel. It just provides so many risks, and you spend more time checking the Excel formulas, I find, for big reports, especially important ones. We've all heard of Excel formula errors. There are many out there. If you review the average set of accounts, you're bound to find some. So just get out there and find yourself an automated solution.
So there's a time and place for everything, but not necessarily for Excel.
That's right, yeah. That's
okay. Thank you very much, Josh. That's been a really insightful talk through your journey, so I appreciate that. Please keep coming through the questions online, pop them through, and we'll do what we can to respond to those. Let's just think now about what we've learned and what conclusions we come to. I'd like to just come back to some of the comments that Josh has made. There's some quotes here from various other customers, and you can see those. I won't go into many detail, but it's very clear that augmenting your ERP, whether it's SAP or Oracle or JD Edwards or whatever, does pay off. And there are things that ERPs are good at and things they're not. And it sounds like if you can augment your ERP with a very specialized application for this domain, then it certainly pays off, as Josh said, in pretty short order. So that's very good news. And I think in this close cycle, clearly a manually intensive process, document-centric, those have got to be the places we start, because those are the places we need to just eliminate the checking and control problems that Josh referred to, and these are just sitting there waiting to be automated. And the number of people who tell me about the document storage and binders and locked cabinets they no longer need to worry about, you can't even shake a stick at. So definitely this is a big topic here. And one of the things I've learned, certainly from this conversation, is not all change needs to be painful. I think we're so used to, in this day and age, when people talk about process change or system change, there's a sharp intake of breath and a feeling of pain in the abdomen, and which is probably based on experience of large-scale ERPs and all sorts of other systems. So it doesn't need to be painful, and I'm very impressed, Josh, that you managed to do all that, with the team, with no extra resourcing. I think it's amazing. And you see some of the other comments here. So, and then this whole point about efficiency and control, I'm always fascinated by the fact that quite often in business we see efficiency or productivity as kind of the enemy of control and risk management. And here's a great example of where efficiency and better control can be achieved in harmony. And I think that's excellent, because risk and performance are two sides of the same coin. So this is a very important element. So that's kind of some observations, both reflecting what Josh has said and what other people are telling us. I think in terms of conclusions and how you approach this, there's a pretty well established best practice approach. And Josh sort of outlined very clearly how they went through this, but clearly understanding the capability you have as an organization in record to report and in the close to report cycle, both the capability you have and the performance you have against that capability, understanding that, working out with your stakeholders what the priority areas for improvement are, winning commitment to those, and then mapping the tools to that desired better practice. Obviously, you've got to choose a provider and a partner to help you down that road, and then proper preparation, planning, and implementation, and then driving continuous improvement. And I think that's a pretty well-proven methodology. Certainly, we would advocate without any shadow of doubt. So that's how to build a better way. I think I'm not going to go into this in a lot of detail. We covered the maturity model for key processes in a previous webcast. If you're interested in this, either drop an email, put a question in, or look at our previous webcasts. But in terms of understanding the capability and performance gap, you need to have some kind of framework for doing that. And we have this idea of for process owners, people who own the record-to-report cycle, or indeed purchase to pay or order to cash or whatever, a process ownership capability maturity model where in every one of these processes we're planning, delivering, monitoring, improving, assessing. There's kind of a 10-stage or 10-step way of looking at the capabilities in detail, whether it's from process design, control and compliance, skills, talent management, automation, in these 10 areas. And each one of those, I'm going to have 20 or 30 subtopics for us to get together and say, what is the capability we have, what's the capability we need, and that allows you to get consensus around what the priorities are, and then you can map that to the tools you may need, or indeed the improved controls or the changes to organization or process. So that's definitely the way forward. So that's the maturity model. By all means, ask us more about that. So I think I like this picture. We can worry about the wind when we're at sea. We can expect the wind to change. But if we're going to act as leaders, we just adjust the sails and move as fast as we can in that the conditions allow. And I think what Josh has shared with us is a great example there of how to do that. So we do have time for a few questions and answers. You have still pop them in. We won't be able to get through all of them, but put them in and we will get back to you by email. I will just pop up a couple of these things. here. Right. So there's a few questions which are should have seen this coming. Something we overlooked, Josh. One questions, 3 or 4 here. So what solution did you actually select and implement, and why? Why did you do that?
I wasn't sure whether I should be mentioning. We went for a solution called Blackline. They are an American-based firm who are building a presence worldwide, but especially in the UK. They did a very impressive presentation and just came across with a real energy, warmth, knowledge that just impressed us, and it was the fact that the company was a very young firm and they were able to offer us support throughout the implementation process, the training phase, and thereafter. Since then, I mean, I still speak to them regularly with questions, and they're always happy to answer, and there are no kind of unpleasant bills coming through the post. They're just very, very decent people, and it's fantastic software, very, very user-friendly, very intuitive. It's excellent.
So one of the things I've noticed about Blackline is the people behind the product are definitely, they're accountants, they understand the record to report cycle, they understand the close process, which is pretty important. So it's not just technology looking for a problem. And the other piece I've been very impressed with is that this whole user community that you refer to, the fact that users are effusive and get together and share best practice.
Yes, so absolutely. They're very, very good.
And also, at Consider, we're also partnering with Blackline, so that's good news. Another question here, you talked about 6-month lead time to implement. Did you parallel run the old Excel approach with the new tool for that 6 months?
No, we didn't. The first, I'd say, 3 months was building the charts of accounts and the feed from our ERP, I think I mentioned before, SAP, so that it all worked smoothly. We then did some testing, built a dozen frameworks for the balance sheet reconciliation templates, sorry, not frameworks. And the templates then have are then set up and applied to the different areas of the balance sheet. We then had 2 months of running in parallel, and if I'm honest, it was completely unnecessary. We could have just set it free and gone, but I'm nervous and I wanted to ensure that there was some control around the whole thing. We could have done it after 1 month, but it was a quarter around that time. So.
Well, as head of financial reporting, I think everybody would be very grateful that you have a level of checks and balances in that. That's probably good news. Okay, well, thank you very much, Josh. We have come to the end of our 45 minutes. Thank you all for your time. There are other questions we'll respond to by email. I hope you found it useful. I wish you the best of the rest of your day. If you're interested in more about financial close automation and what you've heard today, or the whole concepts of process ownership, and the role of the global process owner and the maturity model for that to help manage and get consensus on that, or the broader risk and compliance topic, you know where we are and how to get hold of us. Thanks very much indeed, and have a great day. Good afternoon, good evening.